Good day, everyone. Happy New Year. Welcome to our very maiden episode of ROCH Playbook for Businesses. Ordinarily, we would start with regulatory updates, but today being the first day of January 2026, the Nigerian Tax Act becomes operational. It is our duty to guide you to the relevant sections of the law that applies to your business. Not that all sections are not important. There are very important sections that determine your business liabilities and your tax burdens. And these sections are the key sections that we want to highlight on. It is also pertinent to note that the new Tax Act repeals the Company Income Tax Act, the Personal Income Tax Act, the Value Added Tax Act. It creates a uniform tax framework that simplifies your tax obligation. Under the old Act, a small company was defined as a company with an annual turnover of not less than 25 million. Under the new Act, this has been expanded to include a company with an annual turnover not exceeding 100 million. The very beauty of this provision still is that for a small company, tax rate is still at 0%. What does this do for businesses? It helps you scale properly without worrying about your tax liabilities. For companies other than a small company, you are expected to make a 30% return on tax. It is very pertinent at this point to understand that your turnover is your gross revenue before any deductible expense is made. That takes us to what deductible expense is and the capital allowances that you are expected to know before taxation. You are not expected to be taxed for your capital expenditures. You're not expected to be taxed for the cost incurred in the cost of production, for salary, your rent, capital expenditures like machinery. Now, if you do not understand the provisions of the law as it applies to your deductible expenses and capital allowances, what this means is that you may not clearly take the benefits that are accrued to you as a taxable person in Nigeria. It is very important that you understand your tax obligations, especially as it relates to these two factors, because they more than anything determines what you declare as profits in a given taxable year. All forms of property are chargeable assets. It is not restricted to real estate, it's not restricted to real property. Virtual assets, digital assets, under the new Tax Act are seen as chargeable assets. It means that your NFTs, your cryptocurrencies, as the new law applies, are all chargeable. What is value added tax? The law has a fixed charge for value added tax at the rate of 7.5. Now, most businesses struggle to understand their obligations when it comes to VAT. They struggle to understand the remittance, what is necessary, and how to withhold when the law requires that they withhold and transfer to the relevant authorities. Now, we are going to give a very simple explanation of VAT. VAT applies at all stages of production. In fact, the main person who bears the cost of VAT is the final consumer. To simplify VAT, let us use a scenario. As a supplier of goods or services, if the cost of production of that goods or services is, for example, 10,000 naira, what is VAT? VAT is 7% of 10,000 naira added on top of the 10,000 naira. And who bears this? It's definitely not the supplier. It is the final consumer of whoever the supply is made to. This is VAT in the simplest form. We have exemptions to VAT and we have products that are charged at 0%. These two are very different. For products charged at 0%, we have crude oil, we have baby products. Now, for products that are fully exempted from tax, we have the food items, we have medical supplies. These products are fully, you're not expected to remit VAT. You're not expected to have anything added to the final consumer. They are VAT free. Under the new Tax Act, low income earners are not expected to pay tax. They are charged at 0%. Under the new Tax Act, who qualifies as a low income earner? Anybody whose annual salary is below 800,000 naira. After that threshold, moving forward, the system becomes progressive. If we were to apply a progressive tax system to what we have already, it creates a balance in society. People who earn higher are expected to remit more tax to the government. What is stamp duties? For every transfer in real property, stamp duties accrue. It is expected that the transferee of an interest in real property pays his stamp duties within 30 days of such transaction. Now, there's no fixed percent for stamp duties. Stamp duty is dependent on the type of real estate or real property transfer. It could be ad valorem, it could be fixed. It has been stated in the 9th schedule to the Tax Act. The 9th schedule to this act shows in details the types of instruments, persons liable, and how it is to be paid. Every business owner that intends to transfer assets in real property should be versed with the provisions of the Act as it pertains to stamp duties. The Act provides for the economic tax incentive. You may ask, what businesses are targeted by the economic tax incentive? Now, for every sector of the economy that is vital for indigenous economic growth, what are these sectors? Sectors like aquaculture, mining, manufacturing, production of digital contents. These sectors can benefit from these tax incentives. The procedure for applying for these tax incentives are well stated in the Nigerian Tax Act. Business owners should always be aware of incentives that can help them cut down on the cost of production, and this is one of such. The Nigerian Tax Act may have been introduced at a time where businesses are struggling to stay afloat. But if properly harnessed, it forms the fulcrum for sustainable development in the country. For more information on this, we'll have our article at www.rochattorneys.com. If you want to know more, please stay tuned. Thank you.